Assalamualaikum and a very good day. Uh, Over here, I'm going to share with you a lecture on financing income producing in real estate. This is our chapter 2. In this topic, I'm going to share with you the income producing property. What is the income producing property? Valuation of income properties and debt financing, taxation of the income properties. So we're going to learn about what is income producing properties. Income producing properties, including lease, rent, and market for and the market of space. Property types. We have to know about the demand and supply analysis, of course. We have to look at the business of real estate, the market income producing in real estate, income potential, the real estate, and developing the operating income. Yeah. So property type, usually for income producing property, we have in residential per se, single family. For a multiple family, for instance, a differentiate between the location and urban. Sometimes in urban area, is going to be like a multiple family living in same residential. And if you were to look at property type under non-residential, we have office, we have hotel, we have recreational, we have retail like shop office. We also have industrial warehouse and perhaps institutional, like education institutional, kindergarten, perhaps what is that? Madrasah for the special purpose, or perhaps we're going to have the institutional like hospitals, for medical institutional, and mixed use of development of property type. So I think you just read through. Okay, we have to know about demand and supply analysis, where there's in the market, if there's a lot of supply of residential, or we have a lot of supply of that particular property types. So if the supply and there is and the demand is low, so likelihood the property is not going to have so much income producing to the owner, to the investors. So we have to really focus. We have to really focus on as to whether that particular investment can bring about a sufficient income for the investors. So where the demand and supply, demand is on the way around. If there's a high demand, usually the price is low. And if the price of the particular property is low, it means very low, or usually the demand is high. Okay. All right. So looking at the demand and supply analysis, I think you have learned it on your economic studies. So usually, the demand and supply will shift according to the designated target of the or we call it as a equilibrium, where the demand and supply will meet each and one another. So in real estate business, we look at real estate business. Most of the tenant find leasing is more, most of the tenant as a business owner usually find leasing is more cost effective than owning the particular properties. So this created the lease market for income producing properties, especially the business, the retail, the office, and other kind of non-residential properties. And another thing is actually if why a business choose of not owning the real estate is because they can able to choose the place they want to stay, or they want to operate. They have more flexibility in terms of operating. Another thing is the cost of building maintenance. So as a leasee, as a tenant of that particular property, they will have less cost for maintenance of the property, because the property is owned by the owner. The owner is the one who responsible to maintain the cost of maintenance of that particular property. And okay, we took a look at this one is a market for income producing property. How is the market? The general relationship is actually depend on the location to maximize the profit. Yeah. And we take a look at the desirable, the general desirable ability among the users to lease rather than the own the space to need for their operation. The advantage of in terms of cost effectiveness upon the real estate business industry to perform the function or and risk associated with the developing, owning, and then maintaining the particular property or land. So market for it as a service, tenant are searching for location that provide a good and highest profit. And the real estate investor owner can able to own a steady income, and at the same time the owner, a real estate owner, engage with providing the service in the exchange for rent. Okay. Okay, potential real estate. Okay, it must be looked at the economic outlook, economic base of the area that the property is located, the demand for types of space provided by the property in the location had been analyzed. We have to analyze, and supply of similar competitive space. And we have to look at the supplies of the competitive. Is there any other kind of similar properties that is actually offering space for rental? So this is going to affect our income of the rental properties. So real estate is, as I said, we know all is a durable asset that is relatively have a long economic life. So market rental are given a point or in time that the price of user must pay in a particular space. For example, rental per square foot of a leasable area of the building. And market rent can change over time, over the economic life of the building, because of change of demand on space from the potential user, and the change in supply of space, in addition to deletion and are made to the stock of availability of the space. This change one source of volatility that will affect the rental income from the property over the time. So you can read through over here. Rental income, you need to know what is rental income. Rental income is initial rent that must be paid under the lease contract through a specific amount of dollar, monetary, as we refer as a minimum rent and a base rent. And this base rent must stay in the same change during the term of lease. There's many way of rent can be adjusted over the term of lease. Adjustment are usually depend on the term of lease and amount of space being leased. Usually rental income are subject to change in subsequent year, as stated in the tenancy agreement, with provision of determining the increase of the percentage of increase. So take a look at this example. Rental income, for instance, is 2,800, and maybe add another income like, maybe parking whatsoever, and rental, and add a rental recovery, expenses recovery. So over here, the particular owner of this property is going to get 3,320. Then less the vacancy and the collection losses 200, for instance, concession 100, for instance, and we're going to have an effective growth of income. And then we have to less the operating expenses. What is the operating expenses? Usually the maintenance and maybe any capex of improvement of the real estate. So all in all, over here, from the 2,800 of amount of rental that we going to get, the net operating income or net cash flow of this particular property is only 570. Others is actually will be a cost for the particular rental properties. Okay, take a look at the cash flow of the properties. Rental, for example, rental revenue equal to base rental per square foot time rentable area. And of course, from here, we can look at the multiple as to whether the multiple rental area or floor of per floor or loaded factors. Loaded factors per floor, rentable area per floor, for instance, and divide by usable area per floor. So over here, we take a look at this cash flow. We take a look at this cash flow. Rentable area, we have about 459,295 square feet with a 7-story. Rental, we have tenant of 65 tenant. Occupancy rate is 95. Rentable square feet per tenant average 7,000, and underground parking we have 200 park space, for instance. So the revenue over here is given to us is 11,780,917. So this is actually the gross rental based on the how to say the rate of $25.65 per square feet time the rentable area. Okay, rentable area is this much. So we assume we're going to get 11,780,000. All of this we have to add other kind of income that might be derived, other kind of income that may derive from this rental is maybe we're going to recover any expenses from the tenant. That's 1,139,000. And then over here, maybe we have other revenue. For instance, retail service. We have lobby to be rented out, cell tower rental, storage fee, and parking, of course. Parking because this is a level of multi mixed development. So we have a parking about 381,215. This is the other kind of revenue that we're going to derive from these properties. However, we have to less the vacant. Over here, we assume that we're going to have a 5% vacant because we are given information that the occupancy rate is 95%. So assuming that 5% is the gross rental, it's going to be a losses to the property. So we have to consider the losses that is 5%. And perhaps we're going to have a kind of concession cost that is 1,000. And the effective, from here, we're going to get effective gross income over here is 12,675,727. And then we have to less the operating expenses. What is operating expenses? For example, property tax and quick rent, management and leasing expenses, insurance on the particular property, maintenance and operation, janitorial and cleaning, and of course utility and other kind of business or tax. So all in all, the total operating expenses is 6,149,959. 59. So perhaps over here we allow another capex on it. So the net operating income or NOI of this particular property is actually 3,976,681. Okay. So this is actually the net operating income over the revenue of the property, that is 11,000. 11,000, meaning to say it's like, less than or close to like 25% of the rental revenue that you're going to derive going to be the net operating income. So this is actually a residential. What about if the particular property, I just want to show you cash flow, or a property that is actually for instance is shopping complex, shopping centers. So shopping center will be the same. We also have to, first of all, we have a revenue, and we have to add other kind of revenue that we're going to derive from the rent from the particular property instead of the base rental. Then we have to consider the vacancy of the particular properties, vacancy of the particular properties, because this is going to be a cost and they're going to lessen the effective gross of income. Then lastly, we have to consider the operating expenses that include the maintenance, the leasing expenses, the property tax, insurance, and others. And then we have to also consider the capex. The capex is actually another cost that is actually the intrinsic cost over the property. And lastly, we're going to derive the net operating income. Okay, so you can look over here. For the revenue of 4 million, actually the net operating income is only 2 million or 2.9 million. So this is actually the way you have to look at the rental. Meaning to say, if you want to look at what is actually the income generating from the particular properties, is actually we have to consider all the expenses. First one is actually we have to consider the maintenance fee, the tax, property tax cost, and other kind of costs. So the income, property appraisal, and capital, and the capital for market for the capital. For instance, we have to look at the valuation fundamental appraisal process, or an approach of the valuation. We can use also sale comparison method or income comparison method, and we have to determine the value, land value, high to the highest and possible. Okay. Okay, the valuation fundamental, we have to know the basic lending decision because the property either full or partially security for the loan. And then how is we want to know the particular process of an approach of valuation. First, we have to look at the physical and legal identification of the properties, identify the property right. What is the right? Is it a leasehold? Is it a freehold? And what is the title of the property, for instance? I mean the title, and then look at the specific purpose of that particular appraisal. What is the why is this appraisal or valuation is being carried out? Why is it so? And then we have looked at specific effectiveness date of the value estimated. And then we have to look at the gather and then gather the and analyze the market data, and lastly to apply the technique to estimate the value. So comparison approach is very easy because we have to compare and compare from the previous or recent sale of data of the similar property that we want to appraise. And of course, the sale must be an arm's length transaction so that we can understand, because you can understand, and it because the data actually represent the normal market transaction with no unusual circumstances or closure. Through this, we actually can estimate the particular properties valuation according to the comparison of a previous historical market price or transaction. This is an example. So other one is actually the income approach. Income approach we have to appraise in the future. So we have income approach is actually a principle of valuation that the cost is related to how to say the ability, looking at the ability of the particular properties able to produce cash flow. Okay. When it attempt to estimate the value using this approach, the analyst must take into account the market influence that affect the cash flow, as well as extracting data from the sale of competitive property deemed to comparable to the property being evaluated. So we will take a look at it when we go into a technical one, technical approach. So how we want to look at the capitalization rate. What is capitalization rate? Capitalization rate is actually the calculation is actually operating income divided by the market capitalization rate is derived from market value. Actually, capital rate or CR is actually the formula is net operating income divide the market value. So we can know, okay, for instance, we can know what is actually the market value. As I said, that is why we need to consider what is actually the value of the property, because from the value of property and we were to get the net operating income, so we can know what is the CR. And of course, we can use also the CR, capitalization rate, in order for us to forecast what is actually the market value of the property, right? Okay. For instance, you look at here, we have this is a target property. We have a comparable price. We have a comparable property, property 1, property 2, property 3, and this is actually the net operating income of the property. So net operating income, what is going to be net operating income of this property, our target property? We would to take a look at other comparable properties in which there are other comparable property, they will have like 9%, 9.8%, 9.4%, and 9.9% of CR, capitalization rate. So we can assume that the target properties would have the CR around 9.9% till 9.445%, right? Okay, we were to look, of course, when we talk about future income, and we were to look at the future of the property income, although the property might will guarantee you that they're going to produce an income, but that income is in the future, that we might not know what is going to happen in future. So that the income that you might derive from the future, you need to discount it to the present in order for us to make the decision as to whether this particular income producing properties is worth or not. So take a look at this one. For instance, over here, I'm going hypothetically, the net operating income will be stabilized at the long-term rate of about 9% in the 6 years and after that. So this is actually the NOI and the percentage of discount. And step 2, you have to select the discount rate of required rate of return, and these particular things that you have to, and then step 3 is to final calculation of present value. So first of all, you have to look at the this is actually this discount factor. Discount factor, assuming that the discount factor is 12%. Okay, so you might derive, okay, over here the discounted NOI is actually net operating income over discounted factors, and you're going to derive a discounted NOI, and at the end of let's say in this at the end of this case, let's say at the 9th year, this property is able to be sold at 4.5, 4.5 million, 4.5 million in the year 9, for instance. So this amount need to be take into consideration that is going to be a huge and it need to be discounted. Discount need to be discounted. Like say, meaning to say this property going to be sold at 9 year, and the value of at 9 year is 4.5 million. 4.5 million over here. Okay, you already discounted the income, net operating income. This is net operating income, right? So net operating income, you need to convert it into a discounted value, so to represent the present value. And this is the resale value that we assume at the 9th year that's going to be sold at 4.5. So this 4.5 need to be also discounted in order for us to know what is the value of 4.5 in the first year. Now, this is the 9th year, and it is now 0. So what happened is actually you need to bring the value of 4.5 million that is assumed to be the value of the property sale sale price to the current, this is present here. So you need to bring it now and between today. So you need to discount it, and the value is actually 1.6 million. So this value, add to this value, you're going to achieve that. At the 9th year, you're going to achieve 1.8 million. 1.8 million is actually, you have to consider it together with all the distributed, accumulated discounted value. So you're going to receive about 4.9 million. 4.5 million. Sorry, 4.5 million. So how we want to look at the land value. We look at the highest and best use analysis, volatility of the land price, higher and best use analysis of vacant site, and higher and best use of analysis of improved properties, speculation, expected use of the land and its future income that determine its value. And as a developer, the investor innovation that will bring the highest and best use of the property value, competition for site and price paid based on the site development will ultimately determine the land value. And we have to look at analysis that already improved on the site. Okay, meanwhile, in the cost approach valuing, so we have to look at two general things, that is the age of the structures of being valued, and as whether the structure is highly specialized or functional, and the availability of data to use for cost estimating. The cost approach is more reliable where the structure relatively new and depreciation cost does not represent the serious implication. Okay, this is actually the approach of cost approach. Okay. Okay, now I want to look at, I want to share with you the effect of debt financing on the income producing properties. What is the effect of debt financing upon and tax upon the income producing properties? So through debt financing, it can measure the investment performance using ratio and before and after before tax cash flow from the sale. And the effect of reducing balance methods, the taxation of income producing real estate before and after cash flow, and debt coverage ratio. So, okay, take a look over here for introduction for debt financing on how the use of debt affect the cash flow of the real estate investor expect to receive. There's two combination of component of financing real estate, that is initial cash flow. Another one is term loan from the financial institution. So calculation technique use the term loan offer by the bank using the reducing balance method. Okay, in which the reducing balance method calculate the interest payment based on the principal outstanding. This means that interest and principal repayment portion are being equate, and equate monthly installment change over the time, and repayment amount annually. Annually payment. At the early stage of term loan, the interest usually smaller and getting bigger as time the payment is running. Okay, and certain percentage of loan outstanding. Okay, as the loan gradually repaid over the time, the interest rate will be reduced, and the greater proportion contributions is made towards the principal payment. And the payment amount, or annually, or you call it A over here, will be calculated as below. This is the formula. This is a formula on how we want to calculate the installment payment of a particular loan. That is this is loan amount. Let's say in this case 100,000. Let's say you buy a property that's worth 100,000, or the loan value. The loan value is 100,000. This is a PV, and like say in this case is actually the total numbers of payment. Like say maybe over here 3 years, 3 years, and 3 years, because you want to know the calculation in term of months, so 3 years need to be timed by 12, so it's going to be like 36,000. Okay, and then the periodic interest. What is the effective interest that is happening? Okay, let's say in this case the interest is actually imposed at 6% per year. So in the interest percent, that in this case the interest portion that is 6% need to be divided by 12, because we want to know the amount, annual amount, or sorry, the installment amount on monthly basis. So this is a formula in which PV is the present value, that's 100,000, times I the interest rate, 6% over 12 months time 1 plus I, that is what I again is actually 6 divided by 12. 12 is month, 6% divided by 12 to the power of n, and in this case n is 3 years time 12. 3 years time 12 divide by 1 plus I in this case is 6% over 12 months to the power of n, and again is actually 3 years times 12 minus 1. So we're going to get like over here, the total payment, monthly payment is actually 3,400 and 42 ringgit. All right. This is going to be the installment payment of the loan amount. Okay, what's going to affect? Okay, over here, like say over here, you're going to learn, you're going to look at over here, the contribution of payment, like say in this case is actually, another calculation is actually, or for the first period is actually 500 because of this is the interest payment, the interest because of the interest is at 0.05% time 100,000. So the principal is then we have to less the installment. So the second month the interest payment reduced to 416, 487, for instance, in this case. So the loan amount gradually will, the principal amount going to be gradually reduced. This is what we call this method. The term loan method is also being called as reducing balance method, because the principal of loan going to be reduced over the time. Going to reduce over the time, and you can also take a look at this calculator. You just can click this calculator and you can calculate through this calculator. Okay. Okay, example here, the purchase price is 848,000. The deposit is 84. Like say in this case, they buy a property that costs 848,000, and the the deposit is 84,800, and then the loan amount then will be 763,200, and the interest imposed over here is 3.3% over a period of 30 years. What's going to be the installment? So you have to calculate using that particular formula. And rental assumption is actually over here is actually the beginning rental is actually 11,000 per month. So 11,000 per month, we have to time by 12 months. Okay, take a look over here. So as data over here is 848,000. The deposit is 84,800. And then this is the numbers of years. That is going to be N. And this one is I, rate is actually 3.3. So you using the amortization calculators, you can know what is actually the debt. This is what we call debt schedule. Okay, this is what we call debt schedule. Okay, if you want to use the formula that we learned in chapter 1, that is A or PMT, you're going to get PMT, you're going to get this amount. Total payment is total installment. This is a total installment. So this is going to be a total installment for the property. For the property. And this is going to be the interest. You take a look over here. Interest usually in the beginning will be bigger, and as time goes by, it's going to be slower. It's going to be reducing. Okay. Take a look over here. Okay, before tax cash flow and equity divided. Okay, we have to look over here. Okay, this is actually from that particular data. We have to previously we have to take a look at this data. Okay, for instance, the opening balance and closing balance. So this is this data you have to translate in this kind of thing. So rental amount started with 11, like say 11,000 per year. 11,000 per year, and we are given a rental growth on the year, second year, third year. So take a consideration, of the rental increment over the period of time until 10 years. So in the in the second year, the rental grow at 5%. So how we were to get 11, how we were to calculate it? Actually, we have to calculate 11,000 times 1 plus grow, 1 plus G. So how we were to 1 plus D? 1 plus 0.05. So 1.05 times the 11,000. So it's going to be 11,500. So this is going to be the rental amount. So let's say in this example, this is the rental amount. And let's say in this example also, we are given an information that the operating expenses is at 35%. So 35%, meaning to say the net operating income and NOI will be 65%. Sorry, 45%. Let's say the operating expenses, like say maintenance, property tax and assessment, and all that going to consist of the rental income of 45%. So it will result the company to have a kind of 65% as a NOI, as a net operating income. So how we would to do net operating income is from 11,000 we have to time by 65%, because we are given information that the net operating income is actually 65% of the revenue. So we're going to calculate it over the period of 10 years. And then over here is debt service. What is debt service? Debt service is actually the interest. Debt service is actually the total installment. Because this is the cash flow, right? So this is the total installment of the year. So the total installment will be the same, similar throughout the period. It's 40,462 over a period of time. So we have to deduct the debt service, that is the installment, 40,462 over a period of time. And we're going to derive the before tax cash flow. Before tax cash flow would be over here. Like say we have 11 million, 11,000, and of course, that is monthly. We have time by 12. 12, then by 12, and then we have to consider net operating income. Net operating income will be 85,800. Then we have to minus the debt installment, debt service or installment amount. This is 40,000. And then the before tax cash flow will be here is 45,000. Yeah, before tax cash flow will be 45,337, right? So over the time, over a period of time, usually you can look over here, we're going to get the before tax cash flow. Okay. So over here, if you were to notice that, like say in this case, this particular property, the property that actually we bought at 848,000. And this property, like say in this case, we expect that this property will be sold at 1.1 million in 4 years. So meaning to say the installment is not yet. We are in the debt, still financing it, but in the 4th year, this property able to be taken as a like say as a how to say, as a investment. Okay? So we have to look what is actually, this is the expected selling price of the property, and we have to look what is the mortgage balance. What is the mortgage balance at year 4? Mortgage balance is, in this case, this is closing balance. So we have to consider the closing balance, that is over here 684,993. Okay. Again, I repeat, this property actually is actually been financed. Okay. The price of the property, the acquisition price of the property is 848,000, and then we already paid certain of the deposit amount and certain of the initial cost. So the loan amount is actually 763,200. This is the loan amount that we take a loan from the bank. However, at the end of fourth year, the loan amount that is actually at the beginning of first year is 763, now became 694. The balance is now going to be lesser than the amount of the loan, the initial amount of the loan. But this is the loan amount at the end of fourth year. So when this property able to be sold at 1.1 million, so we have to minus the outstanding mortgage balance at the end of fourth year. That is 698,999. So it's going to have a before tax cash flow over here. Is going to get the 401,000. Okay. So imagine over here, if you were to click over here, usually what happen is actually at the beginning of initial year, because we over here is this amount is a deposit. Remember, this is a deposit, year zero deposit that we have to spend on the initial cost of the acquisition of the property, because the bank only will give a loan up to 90%. So 10% of the property price need to be financed and it need to be paid a deposit. So this is amount of deposit that the investor need to spend. So year zero, year one is 1 year, 2 year, second year, third year, fourth year. You take a look over here. This is a before tax cash flow, isn't it? For 45 million, 45,000, 49,000, 54,000 year three, 58,000 for year four. So you have to transfer it here. And then at the year four, instead of just 59,000, we have also need to consider the amount that we're going to get from the selling of the property. So over here, we have a capitalization calculating. The capitalization rate is 13%, and IRR of the equity is actually 82%. Okay. Take a look. An example. If the case study 1 and then case study 2. Case study 1 and case study 2 is a different story, because the same property, for instance, but the debt financing is different. First one, the case study 1 is is financed through a debt financing. Case study 2 is a equity financing. What's the difference between debt financing and equity financing? Take a look at this example. So, for instance, both of these example, case study 1 and case study 2, both receive rental revenue at the same amount, isn't it? For 85,800. Okay. And then you take a look at over here, they have a cost of attributable. They have to minus the cost attributable of for the rental. In this case, it's actually of course similar also, because the cost attributable for the rental is 21,450, for 21,450. So, and then we have to less the cost of general and administration costs. This is the general administration cost. That's going to be like all of it: the administration cost, staffing cost, safety, security, depreciation, the advertising is going to get about 27,460. So it made of the net operating income, net profit before interest and tax going to be similar, 36,890. However, in this case, because this is a debt financing, we're going to bear the cost of interest. So the cost of interest will be a kind of burdens towards the net profit before interest and tax, NPBIT. So it need to be minus. So taxable income is actually 36,890 minus 25,186 is going to get, we're going to get 11,704. It's going to be a taxable income. All right, but okay, and then however, if you were to notice over here, because this is equity financing, Equity financing, meaning to say the fund or financing the property is come from the owner of the company, come from the shareholder of the company. So they not have any obligation of paying the interest because they're not taking any debt. So over here, the interest expenses is zero because no interest need to be paid. There's no commitment to pay the interest. So if you to take a look that the taxable income will be higher compared to this one, isn't it? So through equity financing, the taxable income will be higher compared to debt financing. And of course, when you take a consideration of the taxation, Malaysian taxation is at 24%, what is going to happen? The taxation of the equity finance will be higher, will be larger compared to the taxation if we were to finance through debt. This resulted, the net profit after interest and tax is actually higher for equity financing compare with the debt financing. So the amount of tax difference is amounted like 6,045 ringgit. 6,045 ringgit. This is also been considered as tax shelters. The difference between the how to say financing method do give a tax shelter to the company. If like say the company choose to have debt financing, they will win over the tax shelters. But if the company choose to finance through equity financing, so they will not to have a benefit on the tax shelters. Okay, as simple as that. So over here is after tax cash flow. So now we need to consider the after tax cash. Just now we have explained about the before tax cash flow. Now we have to consider after tax cash flow. What is going to happen after tax cash flow? Before tax cash flow is actually we didn't consider the net cash flow, not considering any effect of the tax. But in real case for income producing properties, we need to pay tax to the IRB, need to pay tax to the government. So what's going to be the cash flow? Okay, tax cash flow. So over here, assuming that this is actually the we have to forecast again. So we have to do the cash flow. This is the cash flow that we're going to get, the debt service. This is the amount. Okay, this is a before tax cash flow. So we'll be using the before tax cash flow over here, and then this is a tax saving, and after tax cash flow will be the figure of over here. This figure is actually come from here. Okay, then we have to minus the tax. What is the amount of tax? Okay, the amount of tax is here. So we have to minus the tax. So after tax cash flow will be this amount. Okay. Another one is we have to consider is when we, on the year of that we sell the property, and in this case we sell the property at fourth year, at the end of fourth year, maybe within the fourth year. So like say fourth year, okay, we have to follow the RPGT, real property gains tax. This is the tax rate that imposed by Inland Revenue Board for any property disposable. So this we dispose when we dispose the property at like say in the fourth year, so that over here we are subject to pay tax 20% out of the property out of the capital appreciation of the property. Okay, what is the capital appreciation? Now we have to calculate the capital appreciation. Capital appreciation or price appreciation is actually how you were to determine the price appreciation is the expected selling price. That's 1.1 million, and the original property acquisition of this property is 848,000. So we were to get the we're going to get price appreciation, or also we call real capital gain, real capital gain amounted of 252,000. So amount of 250,000, and take a look at this table, we are subject to pay tax 20%. So out of this amount, we are subject to pay RPGT as amounted 20% of 252. That's going to be 50,400. So now we have to calculate before tax cash flow from the sale of the property. The expected selling price is 1.1 million. And the mortgage ending balance amount, as we calculate just now, is 698,999. And then it bring about 401,000. This is the cash flow of the selling of the property at 4th year. Okay, then we expect over here that is this is the capital. This is RPGT, real property gains tax. The real property gain tax is amounted 50,400. So we have to put 50,400 over here to minus the amount of cash flow from the sale of the property. So over here, after tax cash flow from the sale is actually we're going to get 350,601. Okay. So, and then after this, we have to calculate the IRR again. So over here, if you were to notice that IRR for the before tax cash flow usually higher than IRR after tax cash flow. So how to calculate IRR, I will show you later. So this is okay. Now we take a look at the demo lah. Okay, this is the demo. I'm going to show you this demo. So pay attention to this demo. Rich Moat Agency, Sdn Bhd bought a property at acquisition price of 450. The margin of finance MOF is 95%. 95%. This is the acquisition price. And the deposit required is 10%. While the legal costs and MRTA will include, there's two things, legal costs and MRTA of 4.5% of the selling price will be included in the loan, okay? Anticipate the rental received will be 3,500 monthly and increase by 5% over on every, sorry, ini Y tertinggal every 3 years. Okay, every 3 years. Okay, every 3 years. The maintenance cost is expected to be incurred at 25% of rental of the year. This is the cost of maintenance. Okay, the interest charge I is actually 4%, and the end period of loan is 25. Let's say this property able to be sold, or minute to be sold at 650 at the end of 6 years. At the end of 6 years, meaning within the 6 years lah. Okay, so assuming the corporate tax is at 25%. Calculate the internal rate of return before tax cash flow. So I want you to just calculate before tax cash flow. Over here also, I provide to you is the installment payment schedule. This is the installment payment schedule. This is the installment payment schedule. Okay. So first of all, we have how we want to calculate. This is the real property. This is the original property price. That is 450. We have to pay deposit how much? 40. We have to pay deposit 10%. That is 45%. So the loan amount will be lesser, right? I mean 450 minus by 45. However, in this case, we are given an information that legal cost and cost of insurance to be included in the loan. So cost of insurance over here is 6.5. Legal cost is 6.5. Over the cost price, the acquisition price is 450. So the legal cost will be 29,250. And the MRTA insurance, that is that is actually 44.5% of the acquisition price. So the MRTA insurance will be cost at 20,250. So both of these costs will be included in the loan amount. What is the loan amount over here? 450 minus 45 is going to be like 400 zeros over here. 405,000, right? Plus to 29,250, 20,250. So you're going to get the loan amount will be 454,500. So this is the loan amount. I repeat, this is the loan amount. This is the I. I is actually 4%. N is 25 years. And K is actually when is the property to be sold. The property to be sold at the year 6. So expected selling price is 650. Tax is at 25%. Okay, tax is at 25%. Okay, how we want to do it? First of all, we need to calculate what is the installment, the debt services. So first of all, we need to know first step. First step, we have to use the formula that we have learned in last week. That is PMT. So we calculate the PMT. We want to know what is the yearly amount of installment for the loan that we take 454,500. How much is the loan need to be paid yearly? Yearly. This is yearly basis. Yearly basis. So yearly, just simple. This is, I think you have learned it before. PMT. You have to calculate the installment. So the installment is 29,093 ringgit. Okay, 29,090 ringgit. That's the installment yearly. Okay. Then you need to know what is the balance. What is the balance of the loan at the year 6? So using over here, we have to use the formula that we also learned in last week. That is B. Last time. So over here we have to utilizing the formula. So the formula, by using the formula, you know that the loan amount that originally is actually 454,500, but after 6 years the loan amount balance will be 382 only. 382 111 only. Okay, this is the loan amount. Okay, now we have to calculate the RPGT. What is the cost? What is going to be the amount of tax that we have to pay the IRB, the Inland Revenue Board? So over here, because Rich Mode Agency is a company, so the tax imposed, because it's actually sell the property after 6 years, the tax imposed not after tax, within the 6 years. So the tax imposed is 10%. So we have to calculate what is the capital appreciation. The capital appreciation over here, because this is the acquisition price, this is the selling price. So selling price minus acquisition price, we're going to get a capital appreciation of 200. 200 over 10% going to be 20,000. So 20,000 going to be the amount that you are subject to pay to the lembaga hasil dalam negeri, that is IRB in this case. You have to pay the tax. This is the amount of tax for the property that you sold within in the year 6. Okay, this is step 4. Step 1, just now you calculate PMT. Step 2, you have to calculate the B, the outstanding amount. Step 3, you have to calculate the RPGT. Step 5, step 5, you have to calculate the proceed from the property, proceed from the cash proceed from the property. So proceed from the cash proceed from the property sold. This is the expected selling price, right? Expected selling price is 650, and the mortgage balance is actually 382. So the proceed from the property sold is 267. 267 is the proceed of, this is a cash that you're going to get, 267,000. Okay, but however, this amount, you upon of this amount, you also need to pay the tax to the government. So you need to pay the tax amount. This tax amount come from the calculation of here, right? So now you get the after tax cash flow. This is the net, or sorry, not to say the net, but it's actually, or should I say net lah, net cash flow of the selling of the property. So you're going to get like 247,889 only. All right, now we have to calculate the cash flow throughout the period. Okay, now we know this is on the year 6. What we're going to happen the year 0 until year 6. So from year 0, okay, this is the cash flow, determine the before tax cash flow. So before tax cash flow in this case, at the beginning, this is the outflow. This is the cost cash inflow. Cash outflow will be the money that you have to pay. So since the acquisition of the property is 450 and you need to pay the deposit is 45,000, the 45,000 going to be your initial cash flow, cash outflow. And you have to pay the maintenance. You have to pay the maintenance throughout the period. This is maintenance. How are we going to get the maintenance? Is actually you have to calculate. Okay, you have to calculate the maintenance. So the maintenance going to be from the income. The income. From the rental income, you have to forecast 25% of the rental income going to be the maintenance. So the maintenance cost, this is the cost of maintenance, right? This is cost of debt services installment. This is the installment, step 1 that you have just followed just now. Okay, and then over here, you're going to get the cash outflow. Okay, cash inflow is the rental. Okay, rental. Rental amount. $42,000 times 0.025. Okay. So this is the cash income. So rental income. So the rental income, this is the maintenance. This is rental income. This is the maintenance. This is the maintenance. This is the maintenance. This is the maintenance. Okay. So the maintenance. So the cash outflow will be over here. And then proceed from the sale of the property, we're going to get 267, like over here, from here. We have to transfer it here. And before tax cash flow will be what is going to happen. Cash outflow, cash inflow minus cash outflow. So because of at the initial year, you have no cash inflow, so it's going to be negative in the year 0. But in the latter year, you're going to get a kind of positive, but not so much. The number is increasing throughout the period because the cash outflow is only 42,000, but the cash inflow only 42,000, but the cash outflow is for 39,000. So the difference is only 2,000 over, but however, it's still positive and positive. So this is how we were to calculate the internal rate of return. How we were to calculate internal rate of return? Okay, internal rate of return is actually by interpolation. Okay, so we were to assume that maybe the internal rate of return of this particular investment lie between 10 to 40. 10 to 40%. Okay, 10 to 40%. This is just assumption. So we have to calculate what is the net present value of 10, assuming that 10% is a discount factors. This 10 is discount factors. So discount factors of the cash flow in order for us to calculate the internal of return is actually for year 0 is 1. For year 1 is actually this discount factor of 10% is 0.091. How we were to calculate this one? How we were to get the discount factor as to whether you look at the annuity table or perhaps you just simply calculate it because the discount factor is very simple. Discount factor is I over I plus N. 1 plus I to the power of N. So I is actually 0.1. So 1 plus I is 10. So 1 plus 10% in the, you have to the kurungan to the power of N. N is 1. So you're going to get 0.9091. I repeat again. For year 2, for instance, is actually 1 over 1 plus I is 10%, that is 1.1 then, to the power of N2. to the power of n2, you're going to get 0.8263, and so the rest. Okay? So when you get the discount factor, then you have to time the discount factor with the cash flow over here. The cash flow over here. So you're going to get this cash flow, actually, the cash flow yang that is here, 200, 2,000, whatsoever. So you have to time, you're going to get this amount. Okay. Then sum of it is going to be your net present value. So over here, another interpolation. Okay, this is only 10% because, as I said, the IRR will lie between 10% to 40% within that range. So we have to get the NPV, another NPV. The mission is to get another NPV that is negative. Okay, in order to get negative, that's why you have to use 40%. You have to use 40%. You repeat the same procedure, but during this time I is different. I is 40%. So 1 plus 1 divide by 1.4 lah, because 40%, right? 1 plus 40% is 1.4. Okay. So 1.4 times to the power of n, and accordingly lah, 1, 2, 3, 4, 5, 6, 6. And so you're going to get negative 3. 1,292. So now you get what happened now. You get the lower bound and the upper bound. So you get, okay. So how to calculate NPV and IRR is this way. It's actually like this. Actually, this interpolation of IRR is actually, we want to know. Okay, let's say this is, I just want to give an example. 10% and 40%. This is 10. Okay, this is 40. This is the net present value lah. Okay, this is the net present value. This one is I lah. The horizon is I, right? Okay, what happened is actually at 10%, you're going to get net present value over here. Okay, you're going to get the net present over here. And at 40%, you're going to get a net present value over here. That's negative. So what happened? Your NPV, okay, you're going to get the IRR when NPV is 0. So we want to know what is NPV, what is the IRR of this particular investment when NPV is 0. What is the IRR? What is the internal rate of return of this particular investment? So looking at this graph, you can easily look that the NPV 0, the NPV will be 0 somewhere here, within 40%, within 10% to 40%. It lies between here, but we're not sure what is it. So how to do it? We have to look the difference between this angle. We want to look as a different. Why? Because we want to know what is the NPV here. What is the NPV? What is the I? What is the internet of return when NPV is 0? This is NPV 119,000. This is NPV negative 3,200. Okay, so we want to know NPV 0. When is NPV 0? What is the IR? So how we want to do it? Okay, we begin with IRR equal to 10. Of course, the figure must be more than 10. That's why 10, okay? But the difference is actually the slope over here. So what we did is actually, the formula is this one is A. Then we have to calculate. Okay, so we want to know what is actually over here. So this one is B. Okay. This one is A. So the formula is actually, they must be more than 10%. So this one is A divide by A minus B. But because B is minus, so A is again A minus B. A is 1,119,640. B, okay, divide by A, that is 119,640 minus 3,290. So this, the below figure will be 122 because 119, A is positive, but B is negative, but minus is going to be positive, right? So positive, we kita add up together. We just plus it, tambah saja. So it's going to be like 122,000. Okay, then kita tengok kat mana pihak dia adalah in between 40 to 10. So we calculate this one first, and then we time 40 minus 10. 40 minus 10 because it's between this area. Dia tak akan jadi kat sebelah sini lah. Between 40 to 10. So 40 to 10. So we going to get that this area is 29%. 29% plus the 10 yang depan ni. So we going to get 39%. 39% of the IRR. IRR is 39%. 39.2%. Okay. So this is the IRR. Now we have to calculate the capitalization rate. How we want to calculate the capitalization rate? The capitalization rate is only, we need to cover all the rental only, not the sale of the property. Rental. This is rental of year 1, year 2, year 3, year 4, year 6. Year 6, we didn't calculate it. Year 1, year 2, year 3, year 4, year 6, or year 5 only. Okay, year 5 only going to be like 15,000. And over the market price of the property. Market price of the property is 650. So we're going to get the capitalization rate over this investment is 2.3%. The capitalization rate is very low. However, the IRR is very high. Okay, in this case. So I think that's all for the okay, this is actually after before. This one is before tax cash flow. You already managed to calculate the before tax cash flow. Now the second step, you have to do the same thing, the same step 6, step 7, step 8 for after tax cash flow. You already calculate the before tax cash flow, now after tax cash flow. So after tax cash flow, how you to do it? You going to get the net cash flow, this figure, from over here. From over here. This one. Except you're not supposed to take the you're not supposed to take the ni lah, the apa tu, the sale price, the selling price of the property. So then you're going to have the corporate tax, because corporate tax, if how you get this corporate tax, you're going to get the corporate tax because of the sale price, rental income minus the operating expenses, that is maintenance. So you're going to get the corporate tax at 25%. You're going to get the total cash outflow. This is the total cash outflow. And then you have to plus the sale proceed. Sale proceed going to be from here. Sale proceed. Sale proceed also need to take a look after tax. After tax. Not before tax. Okay, because this is after tax. So after tax. Then you have to compute. You're going to get, this is the after tax. You could see that after tax going to be a negative kind of form. Most of it negative because you have a lot of you're going to pay tax. Okay, so over here you have to do the same procedure, interpolation of IRR using the same method, and then you get the different figure lah. You get the different figure. Over here, the net present value going to be 92,000, and for assuming that the discount factor is at 10, and you're going to get minus negative 13,782.86 if assuming that the discount factor at 40. So similar. So how to calculate the IRR? How to calculate it? It must be more than 10 over here. And then this A, this one is B. So over here is actually A divided by A minus B. So A minus B going to be, A is 92,000 divided by A again 92,000 minus negative that is 13,786, right? So over 10 minus this one, 40 minus 10%. So you're going to get that 34%, 34%.7. And then of course the IRR will be at 44%, 44.79%. Okay. Okay. This is after tax, cash flow. So then this is your before tax cash flow. So looking at this observation, what is the most financing? Okay, never mind. We didn't take a look at this. Again, we're going to do the tutorial. I think that's all for the lecture. I'm going to give you at least two tutorial. I'm going to demo two tutorial with all of you for your understanding. Thank you very much.